All right, so what do we need to know about S corporations? Well, S corporations are kind of an interesting entity because they are similar to C corporations in that Section 351 and the rules for contributing property are the same as they are for C corporations. However, with S corporations, you do have some limits regarding who can be a shareholder. All right. So with S corporations, only U.S. citizens or residents, estates, certain kinds of trusts, and certain tax exempt organizations can be S corporation shareholders. So a C corporation cannot be a shareholder in an S corporation. Okay. There are also limits on how many shareholders you can have. You can only have 100 shareholders. Now, that is kind of what is considered a shareholder we need to look at, because a family with a common ancestor is considered one shareholder for 6 generations. Okay, so what that means is you, your grandfather, your great grandfather, your mother and your father, and your husband are all one shareholder. Okay, so pay attention to those types of things because you can have 100 shareholders, but each family unit is considered a shareholder. Okay. Okay, also, you have to make an election to be treated as a shareholder. Okay, so there's you make an election and you file a form, and it's form 2553. Okay, and so you have to file that form in order to elect to be an S corporation. Now, the other thing that then you have to do is you have to be organized in the United States, okay? And you have to only have one class of stock, okay? So one class of stock means that you have identical distribution and liquidation rights. Okay, if you have different voting powers, different voting powers are okay. You also have to be aware that there are some restrictions as far as the effective date. Okay, you have to make the election before the 15th day of the 3rd month, all right, that you're wanting to be an S Corp. If you make the election after the 15th day of the 3rd month, the election does not take effect until the next year. Okay? All right, so suppose you want to terminate your S corporation status. There are 2 types of terminations, voluntary and an involuntary termination. If you want to voluntarily terminate your S corporation, for example, say you've decided you no longer want to be an S corporation because you would like to sell stock in a public forum, you want to expand your shareholder base beyond that 100 member limit. So then you would do a voluntary termination. This has to be elected by the shareholders and it has to be elected by shareholders with more than 50% of the stock. Okay. Now, there's also an effective date. All right. You have to make the revocation on or before the 15th day of the third month of the year. And then it will be effective at the beginning of that year. Okay. Otherwise, it is then effective the first day of the next year. Okay. There's also this thing called an involuntary termination. All right. And so you can end up involuntarily terminating your S corporation status if you fail one of the requirements. Okay. And so you've got a couple of requirements, and I'm going to draw a little arrow down here. I sadly did not leave enough space. So here is how you can fail the requirements. If you have an ineligible shareholder, okay, that's one way to fail the requirements. If you have passive investment income in excess of 25% of gross receipts for 3 years, okay, you're going to end up violating your S corporation status. Now, it is important to remember that that passive income rule right here only applies to S corps that were previously C corporations. Okay. Your involuntary termination would take effect on whichever day it's determined that you violated the S corp the S corporation requirements. Okay. And so in that situation, then you would end up filing what's called a short tax year. Okay. And a short tax year is, as you would imagine, less than 12 months. Okay. And so then you just allocate your income into that short tax year between the time period that you're an S corporation and the time period that you're a C corporation. Okay. Now, what about if you involuntarily terminated your S corporation status, but you still want to be an S corporation status? Then you can do a re-election. Okay. But you have to wait until the beginning of the 5th year after termination. Okay, so you do typically have to wait. Now, you can apply for early IRS consent, but it's important then that if you want to remain an S corporation, you pay attention to the restrictions around that S corporation status. All right, so there are a couple of operating issues to talk about as far as accounting methods and periods. So these are all elected at the entity level. Okay, whatever method the entity used as a C corporation, those methods can carry over from the C corporation years. You can choose cash, accrual, or hybrid from an accounting perspective. And you must use a calendar year end unless you can establish a business purpose for an alternative year end, or you have a natural business year end. So the cool thing about this is you don't have all of those issues that you had with partnerships as far as figuring out when that entity year end is. Okay. Income and loss allocations, you have to allocate profit and loss pro rata based on the shares owned each day. Okay. So again, a bit different than partnerships, right? If you sell shares during the year, then you have to rebalance, right? Who owns which, what percentage of the stock, okay? You have separately stated items, like you had in partnerships, okay? And so what do? So when we have an S corporation, we file Form 1120S, but then you're also going to have K1s, okay? And again, you have ordinary business income, and then you have separately stated items. Okay, so here's a list of common separately stated items. The great news is these are similar to the partnership separately stated items. Okay. All right, so here we have an example, and we assume that this S corporation was formed as a calendar year end, okay, and we've got 3 shareholders, all right, and they each get each have equal shares, excuse me, and then on June 14th, all right, one of the shareholders sells his shares to another shareholder, okay? And then we have the following business income, all right? And we're given the number of days, right? So all right, so this goes along with the last slide, right? So how much income is allocated to each shareholder if they use the daily method of allocating income, all right? And I've got all of the figures here for you. I'm gonna work through chance right here, okay? So if we're using the daily method, what do we have to do? Well, we have to look at their total income over the total number of days. And that's $1,000 a day, all right? Then we have to look at how many days Chance owned his stock, all right? And he owned his stock for 165 days times that $1,000 a day. All right, so that's $165,000 for that time period. For that's January 1 through June 14th. Okay, now remember, Chance at that point was only a 1/3 shareholder. So his share of the S corporation's earnings via the daily method, oops, I'll make that look like a 0, was $55,000. Okay. All right, so with S corporations, we have basis issues just like we have with partnerships, okay? And you have to do annual basis adjustments. Now, how is this initial basis determined? Well, it depends. So if you purchase your interest, then your basis is the price you paid for the stock. All right. If you contribute property, then the tax basis of the property transferred minus liabilities, okay, increased by any gain recognized. Your initial basis is similar to that of a partnership. All right, so let's look at Fred, okay, and we're given his beginning of the year basis, okay, and he's got these allocated items, okay, so he gets $70,000 of business income, $3,000 of interest income, $2,000 of dividend, and $400 of tax exempt interest income. What's his basis at the end of the year? Well, remember that when you're doing your basis calculations, right, your basis increases, okay, for additional contributions of capital, all of your distributed shares of ordinary income, interest income, dividends, so these are all your separately stated items. Remember too that tax exempt interest, okay, even though it is tax exempt interest, that still increases your basis, okay? Now, what decreases basis? Remember distributions, okay? Your share of non-deductible expenses, your share of ordinary business losses, separately stated loss items, okay? And remember that your basis can never go below zero. All right, so let's talk about the loss limitations with S corporations because there's kind of an added wrinkle here. So we know, just like we've learned previously with losses, okay, when you have a loss, right, that reduces your tax basis in your share of S Corp holdings, all right? So the basis in your stock shares decreases, okay, down to zero. Remember, your stock basis can't be below zero, okay? So then what happens? So then if you've made a direct loan to the S corporation, your basis in that loan then decreases, okay? So with each successive loss, if your stock basis is zero, any loan that you have made directly to that S corporation now gets reduced. The basis of that loan gets reduced as well, all right? And so what is the rationale for that? Well, the rationale for that is, okay, so then as if an S corporation were to go under, right, then you would be less of a creditor because you have already taken advantage, if you will, of those losses, all right? And any loan repayment in excess of your basis then becomes a gain to the shareholder, okay? So that becomes an issue as well, okay? Losses that are not deductible due to these basis limitations are suspended, right? So that works just like we previously discussed with partnerships, okay? You still have at-risk limitations, just like you had with partnerships, okay? And your at-risk amount is typically the same as your stock basis amount, and you're deemed to be at risk for direct loans, okay? So that's important as well, okay? This post-termination transition period loss limitation, let's talk about that for a minute. Okay, so this rule allows your shareholders to create stock basis, all right, during this post-termination transition period and utilize suspended losses, okay? If you aren't able to utilize your suspended losses during that period, they're lost, okay? Passive activity loss limitations, same thing with partnerships. The passive activity loss rules limit the ability of S corporation shareholders to deduct losses unless they're involved directly in managing the business. Okay, so these passive activity loss limitation rules work the same way they did for partnerships. Okay. Taxpayers also are not allowed to deduct excessive business losses for the year. Okay. And there's, and this applies for each shareholder. All right. And it's the aggregate of business deductions for the year over the sum of business gross income or gain. And let's talk about that specifically. All right, so let me create just a little bit of space here. All right, so this excess business loss limitation, all right? All right, so let's talk through that. So your excess business loss limitation is the excess amount of aggregate business deductions over all of your business gross income or gain plus a threshold amount. And this year, the threshold amount is $518,000. Okay, so what does that mean? What that means is if you have aggregate business deductions that are larger than $518,000 plus all of your gross income or gain, then you are going to be limited. You're not going to be able to deduct that excess amount of business loss. Okay, interestingly, all right, S corporations, shareholders, their share of ordinary business income is not classified as self-employment income. Okay. Now, your salary, if you are an employee and you have a salary, that's subject to Social Security taxes, but it's not self-employment income. Okay. If you have net investment income, then you are subject to that 3.8% net investment income tax. All right. Within certain limits, obviously. And then be careful about fringe benefits, because for shareholders that own greater than 2% of the S corporation, fringe benefits are taxable. They're still deductible for the entity, but they're taxable to the shareholder. All right, so just like with C corporations, we have operating distributions that are classified as operating distributions from an S corporation. If you have S corporations with no earnings and profits, the distributions are tax-free to the extent of the shareholder's basis, okay? And any excess distribution is treated as a capital gain. There are different rules for S corporations with earnings and profits. So we're going to work through an example, all right? And then I'm going to post, I realize that I do not have enough space on the slide that I created to write out a couple of the definitions that I'm going to talk through. So I'm going to post a separate document that will have the definitions. All right. So what we've got is an example here. Okay. And so it's talking about operating distributions. Okay. And so it says, before considering distributions, this S corporation's AAA account. Now, what is the AAA account? The AAA account is called an accumulated adjustment account. Okay. And what it is it's a corporate level account, so it's kept at the entity level. It can go negative, but distributions cannot send it negative. Okay, so what is in that AAA account? Well, you've got a beginning of the year balance, right? And then each year it increases as a result of separately stated income and gain items, except for tax exempt income. It increases as a result of ordinary income. All right, then all of your separately stated losses are going to decrease it. Okay, and then any distributions will also decrease it. Okay, so we're told that they have a positive AAA balance. All right. And they have accumulated earnings and profits. Okay. And then we're told that it's going to distribute $60,000 on July 1st. What's the amount and character that Nicole must recognize on her distribution, and what's her stock basis after the distribution? Okay. So here is the layout of that solution. So what was the total distribution? Well, the total distribution, we were told, was $60,000, right? And so their beginning balance, we were told that, was $24,000, okay? The distribution from AAA, well, if we only have $24,000 in our AAA account, we can only distribute $24,000 from our AAA account, all right? The excess distribution is the difference between those two things. And her share of this AAA distribution was then 1/3, okay? What's her remaining stock basis? Well, her remaining stock basis is $80,000, or excuse me, her beginning stock basis is $80,000. Her distribution reduces her stock basis, and then we have their earnings and profits. So the rest of the distribution then comes from earnings and profits, and her share of the dividend is then 1/3 of that. Okay? And again, I'll post another document that helps with the definitions of that AAA account and the earnings and profits and the ordering of things. Okay, what happens when an S corporation distributes property? Well, here are the consequences to the corporation itself. It recognizes a gain on the distribution of appreciated property. It does not get to recognize a loss on the distribution of lost property, all right, from a shareholder perspective. Recognizes distributive share of the deemed gain, and stock basis would increase, okay? The property is distributed at the fair market value, right? And then, so whether or not that is a taxable distribution is determined by the balance in that AAA account and the earnings and profits, okay? And then the shareholder's basis would be the fair market value of that property when it was distributed, okay? What about a liquidating distribution? Okay, well, the S corporations follow C corporation rules. Okay, so that's a good answer. S corporations generally recognize a gain or a loss that they on each asset when they distribute those in a liquidation. Okay, and that's going to increase or decrease the shareholders' basis, right? If the value of the property exceeds their stock basis, then they're going to recognize a gain, okay? If their stock basis exceeds the value of the property, then they're going to recognize a loss, all right? So at the shareholder level, you get to recognize either a gain or a loss, okay? All right, there are three somewhat unique taxes for S corporations: a built-in gains tax, an excess net passive income tax, and a LIFO recapture tax. All of these taxes only apply to S corps that were previously C corps. Okay, so I'll post a separate document on these as well, because we need to discuss these a little bit, but it's important to know that these only apply to S corporations that were previously C corporations. All right, from an estimated tax and filing requirement perspective, it's fairly straightforward. You generally follow C corporation rules, and if they have a federal tax liability of $500 or more, then they must make quarterly estimated tax payments. Okay. They're not required to make estimated tax payments for the LIFO recapture rule, and they file Form 1120S by the 15th day of the third month. Okay. And then the last slides are slides that compare C corporations, S corporations, and partnerships and LLCs. Okay. So I think these are really helpful slides. And so you should work your way through these slides on your own, and just kind of, make sure you know where to go to reference these, because these can be really helpful as comparison slides. Okay. All right, and that is all I have from an S corporation lecture perspective. I am going to post an additional document, and that'll be posted in the week 15 module.